The next most influential blockchain platform is Ethereum. Bitcoin is a storage of value, that is to say, it is coin-centric. It was created as a medium of payment and a storage of value, an alternative to regular money. Ethereum, on the other hand, was developed as a platform to execute peer-to-peer smart contracts and applications. It supports Turing-complete languages, meaning that it can perform general computation. In other words, any type of code that I run on a regular computer can also be run on Ethereum. Code execution on Ethereum is fueled by Ethereum's internal token called Ether. Ethereum was first described in a white paper released in late 2013 by then 19-year-old Vitalik Buterin, a programmer from the University of Waterloo. The platform had a token sale between July and August 2014 and sold 7.4 million Ether for 3,700 Bitcoin in the first 12 hours of the pre-sale. At the time, this was equivalent to $2.3 million US, or in Bugatti terms, about 1.2 barons. The Ethereum blockchain officially went live on July 30th, 2015, and by May 2016, the cumulative value of Ethereum token was more than $1 billion US. Around the time, the idea of decentralized autonomous organizations, or DAOs for short, became hugely popular. DAOs are essentially programs on the Ethereum blockchain that create a distributed governance. The DAO was a specific project that would serve as a decentralized venture capital, allowing their investors to vote and decide on the distribution of funds between startups. However, in July 2016, these streams came crashing down when a hacker exploited a bug in the underlying code, stealing about $120 million worth of Ether from the DAO smart contract. Outraged by the enormous theft, several voices in the community proposed to defy the protocol and undo the hack. The majority of community decided to simultaneously rewind their own chain and ignore all activities starting from the hack. But a small subset chose not to undo the activity with the belief that code is law. The split that rewinded history is a split that is currently branded as Ethereum. The remainder that believe that nothing, including catastrophic events like the DAO hack, should be reverted, stayed on the main chain, which is now known as Ethereum Classic. On June 21, 2017, the price of Ethereum on the exchange GDAX crashed briefly to 10 cents USD per Ether due to a massive sell order. This is a testament to the massive volatility of cryptocurrency prices. Much of the price is dependent on the public perception of the currency, and here are a few things that affected. Speculation about how the SEC will rule on the DAO hack led to a drop in prices, since more SEC regulation will mean that it will be much harder to trade cryptocurrencies. On the other hand, the advent of cryptocurrency exchange-traded funds, like the Winklevoss Bitcoin ETF, meant that the average person could invest in cryptocurrencies without having to worry about dealing with exchanges and storing the tokens. Initial coin offerings, or ICOs, also have been a huge factor in the price of Ether. We'll talk more about them later on, but note that in the third quarter of 2017, ICO have raised $1.3 billion with 150 ICOs, while seed or angel investing across all tech sectors has raised $1.4 billion across 1,602 deals. Venture capital funds have also started investing into Ethereum technology, either into the ICO like Blockchain Capital or directly into token like Polychain Capital. Given the exploding interest surrounding cryptocurrencies, FOMO, or fear of missing out, plays a role in many people's investing decisions. For better or for worse, people don't want to miss out on the next Bitcoin and end up investing in cryptocurrencies like Ether, driving the price up in a positive feedback loop. The fact that Bitcoin and other cryptocurrencies prices are starting to be broadcasted on public radio further contributes to this FOMO. And economic and political circumstances like Brexit, Trump's election, or India's war on cash can also contribute to driving up the price of cryptocurrencies, since they tend to undermine people's trust in centralized systems and cause them to shift towards more decentralized systems like cryptocurrencies. Due to some economic and political situations, and of course the aforementioned fear of missing out, cryptocurrencies became extremely popular, resulting in a massive hype train. In December 2017, cryptocurrencies started attracting much more mainstream attention and led to a change in the demographic of the people who were investing, in particular, an increase in the number of millennials getting involved. A decentralized application built on top of Ethereum called CryptoKitties, an online marketplace for virtual cats, became so popular that at one point it contributed to 10% of Ethereum's total network transaction volume. It is important to have an educated understanding of the space, rather than just making decisions based on volatility and prices. Though the price of Bitcoin is many times higher than what it was a year ago, it started to take a downward turn in the beginning of 2018 after peaking in December 2017. An increasing amount of international regulation, especially in India, South Korea, US, and the UK, combined with the mob mentality of people investing without truly believing in the technology, led to quickly changing market caps and eventually the hype train crash.
While blockchain technology was initially developed to underlie cryptocurrencies, it quickly drew the attention of enterprises, which wanted to harness the same technology to create private blockchains. We've been talking a lot about public blockchains like Bitcoin and Ethereum. Now, we'll be how blockchain fits in with enterprises, particularly with banks, ironically enough. As a technology that was initially created to avoid large